Inflation is on the rise. It seems like it's out of control. Home prices keep going up and up and up. And even here we are in spring of 2022, and people are paying mad money for homes. What is that going to do to home prices in the future? Are we going to see a wave of foreclosures or distressed sales? Let's talk about that. I'm SandiWarner with Warner Realty Group, and I've talked to a lot of clients recently that are watching this seemingly out of control market. Even though we're seeing inflation climb with gas prices over $6, grocery prices crazy, and home prices seemingly without a limit, the data shows that we are not in a serious housing bubble, that there is nothing on the horizon that is going to create a wave or an increase in distressed properties. Why is that? Let's take a look. The first slide I would like to show you, the first bit of information is for those of you who are saying, or maybe you're seeing it on TikTok maybe you're seeing it on some of the more hysterical news channels, or it's just popping across your screen as a headline. It's important to see what foreclosure activity is over the course of a long period of time. If you look at this chart in front of you, it's got blue lines and red lines. It's called foreclosure activity at an all-time low. You will see that in 2021, we are almost a quarter of the amount of foreclosures that were happening on a regular basis in 2005 and 2006. Remember, those years were another day of heady purchasing. Anybody and their brother could get a loan. They were called the no-doc loan or ninja loans. No job, no income, no documentation. Anybody and their brother could get a loan. And we saw in that time period that people were just being approved for loans at these really probably 6% interest rates, and with no proof that they could buy that house or that they could pay that house. What's confusing a lot of people is that in the pandemic, I forget who it was, but the federal government, and I think it was the Consumer Financial Protection Board, put a moratorium on foreclosures, saying that no bank could foreclose on a property. Instead, this idea of a forbearance, of a workaround, of a deferment, all of these ideas that came out of the lessons the bank learned when they took back all of these foreclosed properties in the mid-2000s, all of these ways were provided to homeowners during the moratorium. If you remember, people were afraid. We didn't know what was going to happen with jobs. Nobody knew how long they were going to keep their job. Nobody knew what was going to happen with the economy. I mean, was it, apocalypse? Was it the end of days? Turned out it wasn't. Not to downplay how serious the pandemic was and is, and many people lost people during that time. But from the standpoint of foreclosures, we had so many safety nets in place based on what we learned in the housing crash that we really didn't see a lot of foreclosures. So number one, a moratorium on all foreclosures, and I forget whether it was 18 months or 2 years. Number two, a dozen or at least 5 or 6 really good ways to work with your bank and make sure that you weren't out of your home and that the banks weren't going to take back all of these distressed properties. So coming as of the end of March, when all of those, there were 800,000, I think 800,000 or 1.1 million homes in foreclosure in May of 2020. At the end of March of 2022, this is what that looks like. 30% of those loans that were in forbearance were paid in full. 44.6 were workouts or repayment plans, and 18% of those, only 18% of those that were in foreclosure are still in trouble. Of that 18%, 17.1 have no workout plan. Maybe they don't know that they can do that. Maybe they're not getting good advice. Maybe they are, they've abandoned their home. All sorts of reasons that could happen, or maybe they're just not eligible. Of the 18.4%, only 1.3 were done as short sales or a deed in lieu or a repayment plan. Well, why is that? let's look at this slide, which is home price appreciation since World War II. It really was World War II where home ownership began to be such an integral part of the American dream. And that was when soldiers were coming back and we had the GI Bill. And so they could buy homes. And we saw, homes being built and purchased by families and neighborhoods cropping up. And this idea that of the American dream with people owning a home. And as you can see, from 1945 to 2006, home prices steadily rose. And even we have this big jump just leading up to 2006 where home prices were so high. After the crash in 2006, you see this big dip, but it never went back down anywhere near what it was in 1945. And since then, it has continued to move upward in 2021. Well, what caused that dip in 2006? In 2006, we had the issue where we had these no-doc loans. We had people who were, anybody and their brother could get approved for a loan with no verification. That's what we were just saying a minute ago, the no-doc ninja loans. And on top of that, there was this concept at the time, it was called equity harvesting. So people that purchased their homes in 2005 and 2006 and saw those big increases were encouraged to take all of the equity out of that home and put it somewhere else, whether they were paying off college loans or buying a boat or whatever it was they did. So if you look at this statistic from Freddie Mac right now, this is a difference in annual mortgage payment for a cash out refinance, meaning they were tracking what was the difference between the amount you refied and the amount that you paid. And if you look, it was super high in 2006 and 2007 leading into this crash, right? The big heady days, even 2005 was very high. It dropped way down 2009, 2010, 2011. In 2012 and 2013, people weren't refinancing. They just weren't doing those equity pullouts. Then we see a little bit of a push coming back up. 2014, a big jump in cash out refis in 2018, dropping back down again in 2019. Now here you are in 2020 and 21, right? People are not doing that. They are not taking big cash outs. That means if you combine the fact that home values are continuing to rise. So we look at the home appreciation since World War II. We look at the fact that people are not doing big cash out refis. What that tells us is that people are retaining their equity in their homes. So the first thing we saw was that mortgage debt is not a problem in the United States right now. According to the Fed, who tracks this, the Federal Reserve, household debt service ratio for mortgages as a percentage of total income is lower today than it was in January of 1980. Meaning that if you look at 2007, the debt service ratio for mortgages as a percentage of total disposable income was up at 7.2. Today it's down at 3.8. In January of 1980, it was at 4.4. So we are lower than it was in the 80s. So yes, the mortgage, people got mortgages on a much higher priced house, but they got that mortgage at such a low rate. Some of these people bought at 2.8%. So it's super, super low. So we have low mortgage rates. We have increasing equity in those homes. We have data showing that people are not pulling equity out of their homes. And we are seeing this steady decrease in the number of homes in forbearance. So yeah, the market feels crazy, right? I mean, even as a realtor, I'll look around sometimes at the market and just can't believe how fast something is selling and for what price. But so far, all the statistics, all the data show that we're still even keeled. We are not in danger of a bubble. So I'm SandiWarner with Warner Realty Group. Make sure you hit that bell to get notified when we put out a new video. Give us a thumbs up if you like this information. And do me a favor, drop in your comment below. What are you seeing out and when you're watching the news or you're on social media? Share those contacts with me or share those articles with me. We'd love to do deeper dives on them and get better information. I'm SandiWarner with Warner Realty Group, making the complex simple.